Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Let's turn to the Federal Reserve. The newest Federal Reserve Governor Stephen Miran making the case for aggressively lowering interest rates to avoid damaging the economy, diverging from some other FOMC members. I'm pleased to say that joining us this morning, live from the Federal Reserve, is Governor Miran himself. Governor, welcome to the programme, sir. We've got tons of time to talk about what's going to happen next, your thoughts on the labour market, the balance of risk, the broader economy. I actually wanted to lead the conversation with this one. Governor, what was your experience like? I'm sure this was unexpected 12 months ago. What was it like walking into the room, and was it different to what you expected?
Good morning, and thanks for having me. It's great to see you again. Look, walking into the room, I had a good briefing ahead of time about what the meeting would be like, and so that was very helpful. But I will say that everyone was extremely friendly and welcoming and kind and collegial, and I really appreciated that. And it's important to understand that the FOMC is a body, the Federal Open Market Committee is a body that makes decisions by arguing on the merits of the economics and the merits of policy. And that's how it was, and everyone was very collegial in airing their views, and I the same, and that's how it'll continue to be. We make policy, as the chairman said last week, by persuasion, and so I will continue to try to lay out my views and make the case as best as I can.
Governor, I sense you got the opportunity to articulate your argument. Just how much daylight did you sense there was between you and everyone else on the committee?
Well, it's sort of funny. If you look at the dots in the summary of economic projections, obviously there's a divergence between my projection for appropriate policy for 2025 versus where the weight of everyone else's is. But if you look at next year and the year after, I'm sure I'm still on the low end, but there's not really that much daylight between all the rest of the dots and myself and following year. So it's really just about the speed with which we come down to what's closer to neutral.
Well, let's get into the neutral argument. I think that's what separates you from a lot of people. So you've got it in the mid-twos, Governor, and you think we should get there quickly. Can you just build out why you believe that's the case and why we should get there so fast?
Sure. So, look, I discussed a number of forces which have kicked in over the course of this year and which are, I think, in stark contrast to where they were last year. So I've argued that neutral was higher in the past than it is now, and that neutral was higher for a variety of reasons, but I've highlighted recently fiscal policy, sort of driving up net national borrowing, decreasing net national savings, as well as immigration policy, driving what was the biggest positive population growth shock in my lifetime and has now turned into the biggest negative population growth shock in my lifetime in very rapid succession. Relative to how changes in population growth, normally occur in the data. And so, to me, when you have huge swings in net national savings driven by fiscal policy, and you have huge swings in population growth driven by changes to border policy, it would be bizarre for me to think that wouldn't have implications for the fundamental structure of the economy that gets reflected for monetary policy in the neutral rate. So my view is that neutral was higher last year because of these reasons. And so last year policy was not as tight as a lot of people believed. And now neutral has come down or is in the process of coming down. And now policy is more tight than people believe. And this has happened recently. These policies didn't change, sort of overnight. They've been kicking in over the course of the year. And that means that policy is becoming tighter every day as these policies continue to kick in. And my view is not one of enormous economic pessimism. I don't think the economy is about to crater. I don't think the labor market's about to fall off a cliff. However, the neutral rate is drifting down. And as a result of that, it's incumbent upon policy to adjust in response. And the longer that policy stays excessively restrictive, the greater the risks to the downside for the economy. If policy stays excessively restrictive for too long, then you do get to a situation in which you have a meaningful increase in the unemployment rate and a failure of the employment mandate.
So, Governor, that's the tension, I think, in your view, that's worth exploring just a little bit more.
On the one hand, you don't think the economy's at risk of breaking down, but you also think we are excessively tight at the moment and getting tighter. There are some people who would say, and we've had this conversation around the table this morning, if we were as tight as you're suggesting, why is the market within 1% of record highs? Why are credit spreads super tight? And why is this economy still doing okay?
Yeah, so that's a perfectly natural thing to ask. And let me say two things. One, I don't think that all financial conditions are universally loose like that. In particular, if you look at the housing market, I think it's in quite a different state than sort of some financial markets and sort of security markets. So I don't think that that's necessarily a holistic look at the world of financial conditions in the economy. But even that aside, I think that people in financial markets tend to focus a lot on monetary policy because interest rates are, sort of huge tradable instruments, right? But there's so much more that goes into determining economic growth and the state of the economy and inflation and employment than monetary policy. And I think that attributing all changes in financial assets to monetary policy can be a mistake. And in particular, that's what I tried to do in my speech. Was to draw out some of these effects from non-monetary policies that are affecting the economy and, of course, therefore also financial markets. And so if you have changes in tax policy, right? Like significant incentives for investing that lower the effective tax rate on capital, of course that's going to get reflected into capital assets. If you have significant changes to the regulatory environment, where you're removing barriers to operations that companies can make more cheaply, which, by the way, is disinflationary and pushes out the output gap, then, of course, that's also going to be reflected in asset markets. So I think it's a mistake to conflate the state of financial conditions with monetary policy. They're connected, they're related, they affect each other, but they're not exactly the same thing. And in the speech, I go line by line through these different items. And the reason why monetary policy doesn't have to react to the hawkish side in response to these policy changes is because they push out the supply side of the economy at the same time that they push out demand. And so if you're increasing supply and demand at the same time, there's no change to the output gap. And of course, it's monetary policy job at the end of the day to be balancing the output gap, to be balancing aggregate supply and aggregate demand in the economy so it doesn't overheat or underheat.
I think there are a lot of people, Governor Miran, who would agree with you that probably the neutral rate is quite a bit below where we are now. You said even the other Fed governors did seem to agree with that, but not necessarily the speed. And I'm still unclear, why do you think it is so important to get rates down by 125 or 150 basis points more this year if inflation is still running hot and you're not seeing anything alarming in the underlying economy?
Yeah, so this year is merely a function of where the calendar is. So my view is that policy is quite restrictive, and so I'd like to adjust quickly to get back to a more neutral area, right? That just means a series of 50s until you get much closer to zero. The fact that it's this year is just a function of the calendar. But again, it comes back to the longer that you stay restrictive, the greater the risks. And let me put it this way, like it was just a few years ago that we were having endless conversations about declining population growth rates and the whole world's becoming Japan in terms of interest rate profiles, right? Those forces are still real. Those dynamics are still real. They didn't go away. Those channels, those channels by which population growth affects neutral rates didn't disappear. I would rather act proactively, right? And sort of, we know that we just had the biggest population growth shocks in many people's lifetimes, mine included, right? We know what the consequences of those are economically. I would rather act proactively and lower rates as a result ahead of time rather than wait for some, giant catastrophe to occur because you suddenly wake up and find out that you are sort of resuming those dynamics. In my mind, if you wait to see the result of that, you will have waited too long and there will have been a potentially quite material downside miss to the employment mandate.
A lot of people on this show have been wondering what the reaction mechanism is going to be for a Federal Reserve. This does start to see inflation as transitory once again. The idea that we have been above 2%, the 2% target for the Federal Reserve for 53 consecutive months for more than 4 years. If there is an upsurge in inflation, how long are you willing to look through that if you are cutting rates before you say, hold on a second, maybe we need to stop?
Yeah, so I would want to understand why there was an upsurge in inflation and what was driving it, and then sort of think about whether that shock is likely to be persistent or whether the shock is likely to be transitory. And it's the nature of the shock. It's not just is inflation higher for a certain number of months, it's why is it higher? or why is it lower? And how long are those shocks likely to persist? And if you have a situation in which inflation is much higher because there's, sort of, let's say a very significant expansion in national borrowing that drives up demand, could be driven by fiscal, could be driven by something else, that might be the type of thing that you would expect to be more persistent in my mind. If you have the type of shock that's driven by a, basically one-off change to tax rates, right, whether that's a VAT tax or tariffs or anything else, that in my mind is not the type of shock that would lead you to think that inflation is going to be sticky for a long period of time. And in fact, there's, most central banks around the world, I think actually all of them would sort of, encounter this in a much more direct manner through changes in value-added taxes. And they always look through them. They always say, okay, look, the VAT went up or the VAT went down, and that's going to affect the inflation statistics for a period of time. But then we all know that this was basically a fiscally mandated price change, and monetary policy shouldn't respond necessarily to fiscally mandated price changes because that's not indicative of changes to the underlying supply-demand balance in the economy, which ultimately drives the type of persistent inflation that the central bank cares about.
Governor Miran, I'd love to get your thoughts a little bit more deeper on housing. This is something Matt Miskin, Neil Dutta have talked a lot on this program about. Going into next year, do you think the housing market will weigh on a deceleration of inflation? Is that part of your thesis on inflation coming down?
Yeah, it explicitly is. Look, supply and demand dominates all things economically, right? And if you're increasing the demand for housing by dramatically increasing population growth without a material increase in the supply of housing at the same time, of course you are going to get upward pressure on shelter inflation. And then vice versa, if you start decreasing population growth because of a change in border policies without destroying shelter supply, or if shelter supply keeps on expanding at a rate that it has been in previous years, then you get a relative change in shelter inflation once again. So it's simple, it's simple supply and demand. If we have a material downward population shock because we have negative net migration, that's a net increase in the supply of shelter. And I think that the study that I cited in the speech on Monday, work by Albert Sayers, found that an elasticity of 1, basically that a 1% increase in the number of immigrant renters leads to a 1 percentage point change in the rents.
Right, but immigration is short-term, yeah. Right? This is a short-term story. Would you be willing to revise up neutral if immigration is not much of a drag?
Well, I have good reason for expecting that the immigration story is going to persist at least for another 3.5 years. And I think quite likely potentially after that also. So I'm not convinced that immigration is really a short-term story.
Hey, Governor, just before you go, because I know you've got to run, have you got a taste for this? Is this a position you'd like to keep beyond the end of this year?
Look, I love this country, and I'm happy to serve this country in any way that I'm asked to do so. But personnel decisions are not decisions that I make.
Stay with us. More Bloomberg surveillance coming up after this. Let's turn to the Federal Reserve. Chris Hyzy of Merrill and Bank of America Private Bank writing loosening conditions, including further Fed rate cuts, support risk assets further. Chris joins us now for more. Chris, good morning.
Good morning. Thanks
for having me. Top, decent numbers like that. Yeah. Labour market data. What do you make of that claims data?
I make of it what I always do, which is week to week is data points are pretty noisy. It doesn't necessarily mean it's a trend, but it is something that I think we'll likely see, which is right around those numbers for the foreseeable future. There's a little bit of a supply and demand balance in the job market overall. Many companies are still in the wait-and-see mode as it relates to how you democratize artificial intelligence. So claims numbers are pretty much in line with what our belief is, which is a re-acceleration coming, not just in real growth, but nominal growth and ultimately profit growth.
Are you seeing any signs of that already? Beyond that jobless claims number, where are you seeing signs of a re-acceleration? Where are things firming up?
It comes down to the beginning of the year before the tariffs were put in place. There was this notion that you'd have double-digit profit growth for this year and then next year. Then it was ratcheted back by pretty much everybody across Wall Street. Now we're back to the numbers again where they were at the beginning of the year. So it's a re-acceleration. We're seeing it already in profit revisions, not just for third and fourth quarter, but already for 26.
Do CEOs and CFOs believe it? Do they believe it enough to actually take big steps and engage in some of the M&A, engage in some of the hiring plans that they were talking about maybe late last year, early this?
really depends on the actual sector, obviously, but in terms of the general broader community, you're starting to see sentiment, the soft data, start to change for the better. Remember when we were all talking about soft data being weak and then it was going to filter into the hard data? Never did. Now soft data is coming back. You're seeing in the small business segment a little bit because of rates coming down, but a little bit better economy, perhaps an adjustment to the neutral rate coming down a little bit, as Governor Miran just said. All of that coalesces around better optimism from the corporate side. I would say this, though. Margins have held in there, and that's the key. The bottom line is being used on an efficient basis. Some productivity is increasing. But when you get a little bit above average inflation, that feeds directly to the revenue line. And you don't have to produce as much to get that higher revenue number. So that's why margins have actually stayed in there, in some cases actually widened out.
This sounds like a perfect scenario. It sounds like just nirvana, investing nirvana. It's priced as though it's investing nirvana too, though. At what point have we priced all of that in and then some that leaves it kind of vulnerable to anything that doesn't look like what we just got from jobless claims?
Yeah, Lisa, that's a great point. And I think a lot of that is priced in the here to now, but much of it is still not priced in for next year. There's a little bit of discounting of what the story I just laid out already, given where the S&P is 22, 23 times forward. I would say that in this asset-light world that has driven the index higher, multiples are higher because they're still driving higher revenue growth. And if you look at the contribution of the tech sector, it's about 44% or so of the market cap of the S&P, but its earnings contribution is in the 30s. That's very different than 99 and 2000, when the earnings contribution was almost 1/2 of that peak.
The investors you speak with, are they more worried about some sort of downturn in the economy, or are they more worried about missing out on the next leg higher?
You know, they're still worried about the downside scenario. They still have that frame of mind of the credit crisis, little frame of mind of what happened in August through December of 2018 when the Federal Reserve was raising rates, when inflation was below their target at that point, and then fast forward into 22 with the inverted yield curve and then the tariff situation in April. So they still have all of this in their mind, and they're comfortable still getting a decent yield on their cash. On the flip side, there are some that are very worried about missing the next move, particularly as it relates to the infrastructure build out of artificial intelligence. We believe there's some room to go there. We would caution, though, the signs of artificial intelligence and infrastructure build out peaking are all about the margin, all about the price side of the equation. We're not seeing that yet, but we need to watch that closely to understand what the demand for that will be once all of this is built.
Clients that are concerned about the downside, is it because they think we're in a bubble?
They always talk about bubbles. Number one question I get right now is, are we in a bubble?
Are we?
I had 4 different meetings yesterday. Number one question. In some cases, in areas that are low quality, that don't have any revenues, that are built to sky-high valuations, you can argue yes. In other areas where they're still kicking off very good free cash flow, the answer is no.
So what's your advice?
The advice is diversified portfolio. I know that sounds like, okay, that's easy.
You're killing us, Chris.
Yeah.
Right? I know.
What's the second question investors are asking?
But diversification works when you need it the most, and you can still participate. So for us, it's about having a little bit more non-U.S. than you would traditionally have. We heard before about potential weaker dollar. Weaker dollar is probably a fading dollar story, not necessarily a weaker dollar story, given where growth is for us relative to the rest of the world and their deficits relative to ours. Small caps benefiting from a little bit of lower rates on the short end and potentially a reaccelerating economy. Mid caps for whatever M&A cycle is around the corner. And then on the large cap side, I think it's 2 stories. It's the rest that we always talk about that are starting to rotate a little bit, a little bit on the value side. Those areas that were starved for capital, like materials and energy and others. We're still overweight financials. We're still overweight industrials, consumer discretionary, and utilities. We're trying to make sure that we stay balanced where we can, but participate in the AI growth story.
Does balance mean a little bit of gold as well?
Well, it's fortunate. We don't actually have it in our asset allocation schema overall, but yes, gold is showing some incredibly different signs than it normally would. It has a negative correlation with treasuries right now, which a lot of people aren't talking about.
And a positive correlation with risk assets for the year so far.
That's right. And also defensive assets. It's throwing off signs. Again, it's not perfect, but when you get one of the largest central banks in the world recycling their own foreign reserves and Euro reserves are not going up, but gold is, that's an interesting story.
What do you think's behind all that? Is there a dominant driver or just multiple pillars?
I think it's this regional economic trade zone developments from this ultra-competitive global world we were in for so long as the world looked to the U.S. to fund their growth. Now with all of that switching, I think you're going to have to see some of these central banks diversify their reserve.
Stay with us. More Bloomberg surveillance coming up after this. Let's turn to tech. Following weeks of massive investment announcements, there are growing rumblings of an AI bubble. Ozan Tarman of Deutsche Bank shrugging off concerns, saying those crying the loudest are the ones who missed the trade. Ozan joins us now for more. Ozan, good morning and welcome to New York.
Wonderful to be here.
It's always a bubble when you're not in it. Is that the takeaway on this one?
Definitely. There is a little bit of bitterness, defensiveness. But that being said, maybe for this show, right the night before, I held this big macro dinner, almost 30 clients, friends, sovereign wealth funds, hedge funds, real money. At the question round session, questioning the bubble, questioning that closed circle, AI to NVIDIA, to Oracle, questioning where we are in the labor cycle. But then trade idea session, gold S&P, long EM. So even for me, as somebody, we exchange messages. You guys know it's like being in the family. I do believe in the risk parity. It's been a great call since the April 9 fear. But to music to Lisa's ears a bit, this is a bit too much. I sense a bit of a fly in the soup. Even today, they talked up. How do we start? Again, red. Nothing major, but red. These memes flying around on gold, on AI. Don't get me wrong. I think when I come back, either from London or here in December, I think we'll still be talking positively about gold, about AI, about NASDAQ. But fear of missing out is turning into a bit of orange sign.
Can we just build on this a little bit, the relationship between risk and gold? Mm-hmm. What the traditional relationship typically is and why it's developed into something else. Why is this the long call on both gold and the NASDAQ? What's the relationship between the two now?
Very good question. It's working on risk on and risk off, John. So obviously, orthodoxy at this moment, it should work because finally, they're not exactly going Stephen Miran's way, but they are cutting. So that's going to help gold. But before that, because of everything going on in geopolitics, Russia, Ukraine, central banks feeling much better when they hold their reserves in gold, it got a big trigger. Besides that, as you know, FX at the end of the day is storytelling. You need a dollar, but you need the other side of the story as well. Even though I'm Deutsche Bank, I share some of your anxiety on what's going on in Europe, on engine of Germany. We can go into our dear island UK, Japan, China laggers. So where do you go? You don't like the dollar for very understandable reasons. Soft dollar is working, but you need somebody, some horse that keeps running, and that's gold.
Well, this sort of goes to the question of what could possibly disrupt these trades. And right now, the feeling is that the only thing that could really disrupt some of the long tech trade would be earnings that didn't come in more positively. Do you see it the other way, that you think that actually more negativity in the economic growth picture has the bigger potential to be that disruptive factor to cause a 3% decline?
I do actually, because November 19, even if NVIDIA's so-called misses, we can find another good story in another earnings. But all of us, you know how these markets are narrative, markets are storytelling. 3 more days like this, Jonathan will open the show a little bit differently. So
please tell us how he's going to open the show.
No, he's going to talk about these orange signs more and more. Also, one thing that I want to keep in the radar, because macro, we need to talk about rates as well. Supreme Court. These tariffs, talking about narratives, all the way from January to April, tariffs was the bad guy. Oh, he's going to do this, that, lightizer, 1930s, and because of that, TY was going to go to 5%, Euro was going to 0.95. All of a sudden now, tariffs are the good guys. Maybe he was right on certain things. Revenue, big revenue generation. On Twitter, my dear friend Torsten's talking about it, my research is talking about it. So if Supreme Court blocks this, that's off the left field. I know Anne-Marie will say maybe 301, they have their plan Bs, etc. But that's going to take 4 to 5 months, and that can finally move the long end.
I love how we don't even have to ask the question, so Ozan already knows what we're going to say. Exactly, which I love. It's fantastic.
I listen to you guys. This is Champions League.
Okay, fantastic. I will just say, though, that this is one reason why people keep buying big tech. And even though they're worried about valuations, that's the one area of growth that's kind of powered really the U.S. economy out of potentially what could have been a recession otherwise. Isn't that the only clean trade right now, given all the hair on the narratives that you're talking about?
Agreed. With gold aside, gold as well works on risk off. That's why even, look, I'm a macro guy. Even if we have when I poll people and they all go for higher, the lower end of that was 3%. If we get for this or that reason 3% correction on S&P, my binky will probably come out on the show and say buy the dip. As important as binky, retail, who want this way or another beat the professionals since April 9, that big panic day on buying those dips, will continue to believe. So that's even my scenario of Supreme Court stopping the tariffs, etc., we need something else. We need more deep-seek moments. We need to question all this close circle between OpenAIs and Oracles and NVIDIA. I'm not sure we're there. Maybe 2-3% correction, but doomsday, I don't see.
But the Supreme Court stopping the tariffs, won't that be bullish for equities?
I hear you. At the end of the day, they will say, look, then they'll have to do even more fiscal loosening. Equities may find a way to see that as glass half full as well. That risk would be the bigger trigger for the long end. We came into summer, end of summer, waiting for these famous trust moments everywhere. UK, France, Japan, of course, US, big beautiful bill. It happened for 4 hours on September 2, led by my island. And then look what the long ends are doing now. So steepener crowd, do you hear them now? Much more quiet on these studios, on the macro dinner roundtables. Maybe they're waiting for something new, and that can be their catalyst, at least in US.
When you have these dinners and you're talking to investors, as you say, real money, are they concerned about what we're seeing out of the US government and taking stakes, and then basically companies maybe wanting to have a better reputation with this administration, considering even investing in those companies the U.S. government cares about?
Very good question. I completely hear you. Intel, Apple, right? They do. So because of that, maybe we have a world in which NVIDIAs keep rising, but dollar also keeps eroding a little bit. So in that sense, it's not exactly a Thatcher-Reagan world, is it? So for many different reasons, this institutional decay, different approach to US, seeing more, how do I put it, Hungary, Turkey, Argentina-like developments in Treasury, Central Bank working together in our USA as well, that makes people hedge more. The important hedge ratios. My partner in success, George Saravelos, I think a very important piece. Everybody was questioning, okay, Ozan, you guys are saying sell the dollar, but if NVIDIA, Microsoft, Meta keeps going higher, that has to help the King Kong dollar. Well, no. If they are hedging, hedging when they buy their NVIDIA, maybe we can have this equilibrium in which dollar remains soft and NVIDIA continues to go higher.
Ozan, just a final question. What's the difference between appetite to take risks right now, comparing the investors you've dined with this week in New York to what you experience on a weekly basis in London?
Beautiful question. Much more US-centered. Doesn't care that much about France worries, Germany, when that stimulus coming, etc. I would say still almost sucked into the equity and credit trade. Look at Oracle yesterday, 3 basis points, 3 basis point concession, that's it. So whether they like it or not, they almost get sucked into whether I give the orange signs or no, into equity and credit. Much more quiet money on the rates and FX. Unfortunately, I'm a macro guy, I need to talk up volatility, but the trade at the moment is volatility is on its knees, and we need some surprise, otherwise FX and rates traders continue to sell those straddles.
Stay with us. More Bloomberg surveillance coming up after this. The Treasury Secretary Scott Bessent reaffirming America's commitment to supporting Argentine President Javier Milei, praising his tireless efforts to make Argentina great again at a gala in New York. Joining us now to extend the conversation, Heidi Crebo-Rediker of the Council on Foreign Relations. Heidi, welcome back to the programme. Just want to build on some of the thoughts of Scott Bessent, the Treasury Secretary, who talked about supporting the economic reforms of Argentina. Can we talk about the regional politics? Why are the reforms of Argentina so important to this White House?
So I think that Milei has really made some tremendous progress with an economy that has been a chronic defaulter and had suffered with huge problems over many decades. So he's brought inflation down beyond where anybody really could have expected and stabilized the currency. So I think everybody was really hoping that the reforms would actually take. But Milei lost support in a regional election recently, and there's an upcoming election on the 26th of October where if Milei loses support in this nationwide midterm, then he'll have a very difficult time pushing his reforms forward, and the markets know that. And so he's faced a lot of instability in the past several days. Last week they ran through about $1 billion plus of their reserves just defending the currency. And so I think really the ambition is for this White House to step in between now and October 26th, give the markets short-term stability in a whatever it takes moment, and put I think the devil is really in the details with the use of the Exchange Stabilization Fund, because that's actually tricky. It's tricky in any circumstance, but Argentina is a very unique circumstance.
Well, also, I sat down with the Treasury Secretary in Argentina in April when he was there to meet Milei, and this wasn't on the table then. And when the Treasury Secretary talks about it being negotiated, the Treasury can't give a swap line. Only the Federal Reserve could. And if it is going to be a loan, then Argentina's Congress needs to vote on it. So what exactly is the U.S. willing to do?
So, I mean, that's the big question. And as you rightly point out, the Fed gives swap lines. The Treasury does not, and it does not use the Exchange Stabilization Fund for that purpose. There are conversations, if you do use that $20 billion-ish of liquid assets that are within the ESF, then, the U.S. government has a process to basically price the risk of the use of those funds. And that's a conversation, this is a little in the weeds, but that's a conversation with OMB. How do you price this risk? And are we going to put this on the table for Argentina? And how are we actually going to do that? Are we going to make the same bet? I mean, this echoes, what Trump 1 did in supporting a massive IMF program for Argentina back in 2018. And the IMF lent $50 billion to Argentina and took a big political risk and sort of lost that risk. And so the question is, if we do this, how do we structure it to protect taxpayers? How do we do it in a way that is useful for Argentina without putting taxpayer funds on the line that it might lose? And and really at the end of the day, how can we do this? The swap line, I think, is just terminology to make it simple for the headline. But this is actually a very complicated financial engineering exercise that's going on.
Well, China has a swap line with Argentina. Is this also the U.S. maybe countering China in South America?
Absolutely. I mean, that's part of it. Not only is this a relationship that I think is real and substantial between the Trump administration and Milei, but China has an 18 billion RMB swap line, and it could be this could be wound down. I don't think that China. I think that the U.S. would really like to see itself be the dominant player in providing any kind of support that Argentina needs. Argentina also is very resource rich. And I think this would be a strategic play as well for the U.S. in a very strategic part of the world, Latin America, where it was pointed out we don't have a lot of great relationships.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.